All right. Hi, everyone. Good afternoon. Thank you very much for joining us today. On behalf of the South African Chamber of Commerce, thanks very much for giving us your time this afternoon. This is another installment of our how-to guide in Singapore for South Africans. Essentially, the first one that we did was about how to move money out of South Africa. The second one was about how to cease your tax residency in South Africa. This week, we're focusing on life insurance in Singapore and a how-to guide for South Africans in Singapore. And next week, we will be looking at immigration by investment. So how do you acquire a new passport through investing? So these how-to guides is kind of my way of trying to bring value to the community here in Singapore and helping South Africans to understand all these financial aspects that once you come out here and you become a global citizen, how does it affect you? So for those of you who don't know me, my name is Michael Booth, and I sit on the board for the South African Chamber of Commerce. I also work for a very large wealth manager here called St. James's Place, and I've been here now for just over 3 years. So I think without further ado, where I'd like to start today is, it was Freedom Day yesterday. So hence I'm wearing my Springbok golf shirt today. But last year we hosted an event where we interviewed the owner of Singlife, and Singlife has recently acquired Aviva. So Singlife was one of the largest insurers in Singapore, and they acquired Aviva, which is one of the largest insurance companies in the UK. Now, what's interesting about this story is that it was started by a South African guy named Walter de Ode. And Walter has been in Singapore for a number of years, but essentially he started this business from scratch and he's grown it to be one of the largest insurers in Singapore. So I thought as a opening for today's topic, I would just share with you a clip from our interview with him last year because it was extremely interesting. So if you just give me a sec, I'm going to bring it up on the screen. And there we go. Right, so here's a little clip from Walter. Walter's originally from Joburg. He went to Wits University and he studied actuarial science. And here he's talking about how he started one of the largest life insurance companies in Singapore as just an ordinary South African bloke.
Which we did. So I got a group of guys together from that I'd worked with around. We had very strong relationships with the regulator here already, given the regulatory type of responsibilities that we had before. I went to the regulators and said, this is something we believe we can create better value for customers through a certain technological design around how we deliver insurance to people, basically disintermediating or making it digitally capable. And went to the regulator and said, this is what we want to do. And the regulator said, yeah, let's support us in doing that. So, starting a life insurance company from scratch was quite tough because you have this, in all startups, normally to raise money, you have to have revenue. And we had this difficult position where we couldn't get any revenue because we didn't have a license to run the business. And we didn't have a license to run the business because we didn't have the capital to support the business. And we didn't have the capital because we didn't have any revenue. Didn't have revenue because we didn't have a license, didn't have a license because no capital. So it was this, very difficult starting point.
Chicken and
egg thing. Yeah. That's right. So it took us about 3 years to raise the capital that we needed. We needed to raise 50 million at the start, which we did. But it took quite a long time, and mainly because the people that provided us with capital had to have faith in our ability to execute based on what we were dreaming of, rather than what we were actually putting in place at the time. And so we're very lucky with our early investors. We were fortunate enough to have the family office of Michael Spencer, the founder of ICAP from London. So he put in, took about 30% of the business at that time. And we had a Chinese investor from Credit China, FinTech, which then also put in about a third of the capital that we needed. And that got us going, and that was the ticket to the races, and we've just been building the business ever since.
So I think it's a absolutely remarkable story here that one of the largest insurers in Singapore is actually owned or was founded and was founded by Walter Doad here from South Africa. So for those of you who don't know, essentially, if you own a Aviva policy, his company acquired Aviva. So it's really fantastic to be able to see a South African entrepreneur, businessman come here, start a business from scratch, acquire a larger big business, and now begin his exit. So this is what's wonderful about Singapore is you get exposure to all these kinds of fantastic people. So anyway, I just thought that was a great place for us to start today's conversation about life insurance in Singapore. And if you own an Aviva policy, it was a South African started business here now. So in terms of what we're going to be discussing here today, I've prepared a whole bunch of stuff, but really it's just going to be an introduction to myself and the company I work for and how I help my clients here. And the types of insurance that's available in Singapore and a comparison to how they work in South Africa. So why is this important? Through my job, I get these questions all the time where people say, oh, I have these policies I took out more than 10 years ago in South Africa. Are they still relevant? If I get sick, is it going to pay? If I get disabled, is it going to pay to me here in Singapore? If I pass away, will my family be looked after? So that kind of spurred me on to put this together for the community here today. And then also something that a lot of people are not really aware of here is that life insurance is tax deductible in Singapore. So if you take out a policy, the premiums that you pay, you can take off from your income tax at the end of the year every year. So that's a really strong benefit that we'll be discussing. And then for the new people, the people who've just arrived from South Africa, and when you're considering getting more life insurance, or taking out further products, what are some of the things that you should watch out for? And I've just put together kind of 3 points for you to be aware of. And the last point, as South Africans living here in Singapore, if you are to pass away here, what are some of the estate planning considerations when it comes to, being offshore and having some insurance? So these are the things we're going to be discussing today. And I think I've prepared enough for around 40 minutes of conversation and information. So throughout, please do put some questions into the chat box. And if I can answer them along the way, I will. And at the end after the estate planning considerations, I've put a section aside for Q&A. So please do take note of some questions and let me know your thoughts, and we can discuss them towards the end of the presentation here today. So without further ado, we'll get it going. I just want to share this. Go. Awesome. Alrighty. So in terms of myself, this is me. I'm a associate partner at St. James's Place, the Heritage Partnership. So the Heritage Partnership is my team and my partner practice. We sit inside of St. James's Place. So essentially it's a team of experienced advisors and support people who've come together to pool resources and give our clients a better experience. As I mentioned earlier, I'm also an executive board member of the South African Chamber of Commerce in Singapore. We've been running it for almost 3 years now, and it's going really well. I'm very proud of the progress we've made. And to all of you who've supported us over the years, thank you very much. We do appreciate it. I'm originally from East London in the Eastern Cape, and I studied in PE and the University of Free State. I'm also UK qualified, and I've got my licenses here in Singapore to provide financial advice. So that's me. Please do look me up on LinkedIn. Just simply Michael Booth, and there's a South African flag next to my name, so it's easy to find. In terms of St. James's Place and the company, it's a really large company. It's been around 30 years. We've got around 830,000 clients worldwide, and we manage about almost 270 billion Singapore dollars. And we're in Hong Kong, Singapore, Shanghai, and the UK. And, something that really attracted me to the business was the investment management approach, but also the charitable foundation and how, you know, we put our money where our mouth is, where it's kind of like we're giving to the community while also trying to enrich our clients, which I think is really cool. So in terms of the Heritage Partnership, this is my team, essentially, our partner practice. And we've got nationality specialized experts. So from British to Australian to German, and then myself looking after the South Africans as well as Singaporeans. This is our team. So essentially, the benefit to our clients is when you work with me, obviously the relationships with me, and I help you build your strategy. But should something happen to me, or if I go on a holiday, there's always going to be someone available to work with you to ensure that you get the answers that you need. Oh, wrong way. So in terms of the services that we offer here, this is a large part of what we'll be discussing today. We do offer life insurance, and across the whole spectrum, we help our clients protect themselves against risk. We also focus heavily on investment and helping clients to build and preserve capital and pass it on to next generations. When it comes to the passing on to next generations, that's where succession and inheritance planning comes into play, where we use trusts and wills, and insurance fits into this very nicely as well, in terms of how do we ensure that our clients are protected while they're growing their wealth and passing their wealth on to the next generation. And so this is what we're going to be talking about here today, mainly the insurance. And I've prepared a bit on this. So types of insurance in Singapore. What we're going to run through now is just the types that are available. It's very broad, and I'm going to give you a few high-level examples of the kinds of insurance and how they work. And then from there, we're going to make a comparison as to how they would work in comparison to South African products. And I found this to be a refreshing journey for some clients because they thought they had enough cover, but once they evaluate it and they take it out of rands and put it into dollars, they really start to question whether or not, you know, 500,000 rand is enough or 1 million rand is enough. So in terms of life insurance, the first one we'll discuss is whole of life cover. And whole of life cover just means that it's a policy that will cover you for the majority of your life. In Singapore, the coverage runs until age 75, but you're only able to pay up until age 65. So you can imagine for those 10 years where you're not paying, those would be built into the first, you know, stage up until age 65. So these are a little bit more expensive than the other kinds of insurance available here. And these are what are called participating plans. Now, a participating plan is where you have insurance and an investment piece put together. So essentially, when you pay a premium, an amount is going towards a savings element and an amount is going towards an insurance element. And the line between how much is going to insurance and the amount that's going into the savings plan is actually really hard to establish. So if you do speak to an advisor here and they want to offer you this, try and understand to the best of your ability why they've recommended a plan that has a savings element, how much of that is going to be coming back to you in the future, and what are the alternatives if you didn't want that. In my experience, generally, these plans, the insurance is rather pricey for the coverage you get, and then the savings element does not perform very well because of the costs of the overall product. But one benefit to this, and this is a big difference between South Africa and Singapore, is that for the term of your whole of life insurance cover here, it's fixed and level premiums. So that means today I'll take out insurance and it's $100 a month, and I pay that until age 65. The premium does not get more expensive. It stays level and it's fixed for the duration. Now, the next piece is TPD. Now, this is in Singapore, as you'll come to learn if you're new here, Singaporeans love to use jargon. And jargon in Singapore is anything with an acronym. So for example, in Singapore, TPD simply stands for Total and Permanent Disability Cover. Now, this is often something that is included in, say, a whole of life plan as a rider. So it's an additional benefit to the main plan. And what it does is, should you become disabled permanently and totally, it will give you a lump sum of money, but it is accelerated. What does that mean? It means if I have $1 million of life cover and I have $500,000 of TPD cover, that means if I am found to be totally and permanently disabled, it will pay out $500,000, but it would reduce my $1 million of cover by that same amount. So when I pass away, after receiving that $500,000 for TPD, my family would only be left with $500,000. So this is what an accelerated cover means. It's accelerated of the main benefit of life insurance. Now, how do they establish if you are totally and permanently disabled? What is the criteria for this? It's actually a very strict criteria, but to sum it up, one of the ways they do it is by looking at what's called activities of daily living, which is this third point. Now, what that does is it assesses if you're able to look after yourself or not by measuring 6 key activities of daily living, which are basically such as toileting, washing, feeding, mobility, so moving from one room to another, these sort of things. So they assess if you're able to look after yourself. Now, in order to have the payout, you need to have 3 of 6 activity of daily livings that you cannot complete without assistance. And how this is proven is obviously by a medical practitioner, and you would use that to submit the claim to insurer. So in terms of becoming totally and permanently disabled, it's quite difficult to claim on these policies. And because of that, this is usually quite affordable cover because the claim criteria is so high. Now, the next thing that is also usually sold as a rider to a main plan, but it can also be sold as a separate or independent policy, is critical illness. Now, in South Africa, we would call this dreaded disease cover. And myself personally, I do think critical illness sounds better because dreaded disease, I mean, it doesn't sound great, but it definitely is going to help sell insurance. So again, this can come out as a accelerated lump sum. So if you were to have a critical illness at suitable severity levels according to claim criteria, it will pay out a lump sum, and the main life insurance would be reduced by that lump sum. So this is, again, accelerated cover. Now, that's one kind. So you get accelerated, but you also get non-accelerated, and you get what's called multi-pay options. So essentially, these are kinds of critical illness cover that would protect you against early stage, intermediate stage, and severe stage illness. So essentially, if you were to contract stage 1 or stage 2 cancer, and then get stage 3 or stage 4 cancer, and then it progresses to the highest level where you perhaps have a few months to live, you would receive a first payout for stage 1 and stage 2, the early stage. It would pay out a lump sum. Then if it progressed, you would get a lump sum again. And if it progressed again, you would get a lump sum. So this is what we mean when we say a multi-pay option. It means that you can have multiple claims on the same policy for early, intermediate, and severe stage illness. Now, for example, the company that Walter started here, Singlife, they've acquired Aviva. And Singlife with Aviva has a really good critical illness policy that it can pay up to 900% of the sum assured. So what that means is that if I take $100,000 as cover and something happens to me, the policy is designed to be able to pay up to 900% of that $100,000. And it will be paid according to claim criteria at different severity for different illnesses. And, you know, it covers 72 different illnesses. And off the top of my head, I don't think I could name 10, let alone 72. So that's critical illness in a nutshell, and TPD. Now, total and permanent disability and critical illness, as I've said, can be a rider to a main plan like a whole of life insurance policy. Now, how is this different to South Africa? We get something here called term life cover. And in my experience, when I was selling these sort of products in South Africa, term life cover is definitely not something that comes up very often. In South Africa, for example, the main sort of insurance that you sell is whole of life cover. So what is term life cover? So term life cover is extremely flexible. What it means is that you take out cover for only a period of time. So if you want to have cover for 10 years, you can do that. If you want to have cover for 12 years, you can do that. Or 20 years, 25 years, etc. It's very flexible in terms of how long you can hold this cover. Now, why would you want something like that? It's useful for very specific planning needs. So let's say that you have your first child is born. You take out this cover for the first 23 years of the child's life for the cost of their education. So should something happen to you, their kind of education from primary school to middle to university would be covered by this term cover. Thereafter, once the period of risk or until your child has graduated after age 23 or 24, this cover can fall away. So essentially what term life cover allows you to do is to protect yourself against very specific risks. So let's say you have a policy to protect your whole family. So if you pass away, they receive some money to look after themselves. And then you had a separate policy to protect you against separate risks, such as this education cost. It could be two plans, one for a longer term and one for a shorter term. You would start off with one premium, and it's fixed and level for the term. But once the period of risk or the time has passed, so your child has graduated from university, the second policy will fall away, which means that your overall cost of insurance would drop. Also, your level of cover would drop, but this allows you to do very specific planning for different financial needs in your life. It's very flexible. And again, this was not something that I saw was readily available in South Africa. Now, what's interesting about the term life cover, again, it's fixed and level premiums, but this is a non-participating plan. So when I spoke about the whole of life cover, I was talking about a participating plan, which is where you have insurance and a savings element all pooled together. Now, term life cover is a pure risk policy. There's no savings element. So this means that this is a rather affordable level of cover for the majority of people who require insurance. Now, why that's also really nice is that term life can also have these riders. So you could add, total permanent disability to your term life cover and critical illness cover all in one policy as a rider. So again, it offers the same benefits as a whole of life policy in terms of being able to add additional coverage within one policy. Why would you do this? It would reduce the cost and it would reduce the admin when a claim would arise. Now, this is something that's very interesting. It's called universal life. And before coming to Singapore, I had never heard of something like this. Universal life cover is also a whole of life sort of cover, but it's variable. It's also known as variable life. So what that means is you can have a certain amount of life insurance for your whole life, a whole of life cover, but you can vary the premiums and the benefits over the term of the policy. Now, because insurance is a contract, generally the terms of the contract are very fixed in terms of you will cover this amount for this amount of time, and that's it. Variable life is interesting because it is not so fixed. So you would undertake a contract whereby you can adjust the premium and the benefits over a period of time. Now, this is also a participating plan where you would have an insurance and a savings element, but these are offered generally at a much lower cost to whole of life. So these are an interesting concept, but generally I have not been found a client who this is suitable for just yet, or who has an interest. For the most part, my clients take out term life cover that would have the riders such as total and permanent disability with critical illness cover. And essentially, they would use this for very specific kind of needs-orientated planning, where this amount is for children's education. This amount goes to my spouse should something happen to me. This amount comes out if I get sick. And then these policies would be for different terms, and they would fall away as the years would go by. So there would be one for a very long period, and then smaller terms for, or shorter terms for other specific needs. Now, the last cover is also something very interesting that you don't see very often in South Africa either, but you do see it a lot in the UK. So decreasing term cover. Why would you want life insurance that for the term of the policy, the amount of life insurance you get gets less and less? It sounds like a bizarre concept. These are generally very practical for mortgages. If you have a bond on a property and you want to have a life insurance policy that covers just that, and this is often something that banks would request as well. As you pay into your mortgage and its value goes down, the life insurance will mirror that, so that should something happen to you, the exact amount that's required for the mortgage would pay off. Now, this again is for a term, and it's usually for the same term as a mortgage. If you have a 20-year, 25 or 30-year mortgage, this would be kind of the insurance policy for that. Now, these can have joint ownership. So if you are, husband and wife and you both own a property, you can both be listed as the owners of this, and it would satisfy the needs of the mortgage provider or bank or lender or whomever they may be. So that's essentially the 6 different kinds of insurance in Singapore. Are there more? Yes, there are. But I thought I'll just start here, and these would be kind of a good starting point to help you understand and come to grips with what is available here and how does it work, and what are the benefits, pros and cons of each of these. Now, in my experience as well, decreasing term, unless this is something that's been requested by the lender, it's not something generally that we recommend to clients. And the reason for this is the cost of a decreasing term policy and a term life ordinary policy, they don't vary that much. So would you rather have a policy that covers you and gives you $1 million cover for the whole term, and as the value of the mortgage goes down and you're able to pay it off with the proceeds of the insurance, that means your family would be left with more? Or would you rather have insurance that, it goes down in line with the value of the mortgage, and should something happen, only the mortgage is paid and there's nothing on top? So again, these are the conversations that I'm having with clients on a regular basis, which kind of fueled me into making this webinar for us here today. So I am aware it's a lot of information. Don't worry, I will be sending the slides to this afterwards. And I have made a very simple 1-page resource that you can download from the SHM website to help you understand all of this. So the next question that you're probably thinking is, okay, right. So how does this compare to cover that's available in South Africa? As I have hinted already about kind of how these do work in comparison, there are a few key differences that I want to bring to your attention about cover in South Africa. Right. So as I said earlier, in South Africa, the most common form of life cover is whole of life cover. Essentially, you will be paying this off until you pass away. For every year, you'll be paying either annual or monthly premiums to cover your life insurance. Now, the reason some people maintain these for the whole of their lives is to cover estate duty costs. So let's say you have an estate of over, 3.5 million Rand or 7 million if you're a couple. you would maintain these life insurance policies. So should something happen to you, there's enough liquidity in your estate to pay the estate duty. But this is where the discrepancy between premium escalation and benefit escalation comes into play. So essentially, what do I mean by that? So if you have ever had insurance in South Africa and you were to look at your life insurance policy statement on an annual basis that's provided to you by the insurer, look at where it says premium escalation and benefit escalation. What you would see is in some cases, your premium every year would go up by 5% and the benefit would escalate at 5%. That means if I'm paying 100 Rand a month, then the following year I would pay 105 Rand a month. But the benefit would also escalate by 5%. So if I have 100,000 Rands worth of life cover, then the following year it would be 105,000 Rands life cover. So the reason they do this is so that it keeps track with inflation. Now, why I say there's a discrepancy is because that's not always the case. I've seen and reviewed some policies where the premium escalates at 12% per year, but the benefit only escalates at 5% a year. So what that means is that for every year that you hold it, you pay 12% more, but the benefit you receive only increases by 5%. It doesn't sound like such a good deal. And the longer you hold the policy, you'll end up paying more and more for less and less cover. So this is why I say there's a discrepancy. And this is something I urge you to look at within your own benefit statements. Now, something else that is interesting is the cost of life insurance. So if you look at taking $700,000 out in life insurance versus taking out 7 million Rands worth of life insurance, you would see, if you did a like-for-like comparison, that generally speaking, cover in Singapore dollars in Singapore would be at a much lower cost. There are a few factors. Obviously, currency is one, but also Singapore's healthcare and the actuarial way of calculating risk in Singapore would be different to South Africa. In South Africa, there are significantly more risks in road accidents, healthcare issues, etc. Whereas in Singapore, for example, things are a lot safer, be it from a healthcare perspective or from road accidents, etc. So because of that, the cost of cover between South Africa and Singapore, there's actually quite a large divide, which is very interesting to see. Now, the biggest difference truly between South Africa and Singapore is that if you have cover in Singapore and it's from a Singapore-based insurer, you can receive tax relief of up to $5,000 per annum. And what that means is that if you pay a policy premium of 5,000 divided 12, $416 a month, that would be completely tax deductible in Singapore. In South Africa, life insurance is not tax deductible. Your health insurance or medical aid, that's deductible. You get different tax credits for that in South Africa, but you don't get for life insurance. Now, that's a really great benefit, and it's something the Singapore government does in order to encourage that people have suitable amounts of cover so that they don't become a burden on the state. Really, I think it's quite brilliant. So these are the main differences. It's not that one is better than the other, it's just that they're different. And a question that you need to ask yourself is, once you come offshore and you're living here, does the cover that you have, be it from South Africa or abroad, be it Dubai or wherever, is it still applicable while you are living here? And is your family still well looked after? Obviously, there's a whole bunch of different kinds of cover. I just covered all for you in the previous slide, available in Singapore. But how do you decide which ones are the best or most suitable for you and your needs? Now, this is where kind of the work that I do comes into play with a lot of my clients, where we look at goals-based financial planning. So what does that mean? It means we sit down and we discuss about your future and the goals that you have for, say, retirement, children's education, and leaving an inheritance or enough money to your spouse to look after them should something happen to you. From there, we work backwards where we say, okay, how much would you like to have in income for retirement? How much would you like to have for education planning based on costs of education in, say, Australia, the UK, and South Africa, wherever you want your kids to go to school? From there, what we would do is we would build a plan where we say, okay, in order to do that, you need X amount of money. Now, this is all going through a process, getting to know the clients and understanding their needs and really working with them to get to a place where they go, right, now this is exactly the kind of cover I need. So if it's term cover to cover these risks and this kind of retirement plan, that's how we go about deciding which levels of cover is suitable for you. It's all based on what are your objectives and what are your needs. Now, how do we actually go about that? We go through a process of plan, design, and review. So the first piece is what I've just described. It's planning, where we understand what you're trying to achieve. The second is we design, where we build an investment portfolio or we choose an insurance policy that's suitable for this, and we put it in place. Then what we do is we ongoingly review this, be it in quarterly or biannually or annually, and we ensure that what you have is still suitable for you today and tomorrow and hopefully a decade from now. So by having this kind of goals-based financial planning, it ensures that you get the right kind of cover that is suitable for you. And that's essentially how I go about with my clients, choosing the different kinds of insurance that's available in the market. So onto the tax relief piece, because I think this is something that would be very interesting to a lot of South Africans in Singapore, is understanding, okay, so you're saying I can take life insurance here and I would get tax relief for having life insurance. If you have life insurance, you don't claim, if you have life insurance from Singapore and you don't claim this tax relief, you can do so. So that's something to be aware of. And in order to kind of understand how this works, all you have to do is Google Inland Revenue Authority Singapore, or IRIS, life insurance relief. And I just copied this off of the website earlier today to share with you guys. So you might think, oh, okay, is this only for locals? And the answer to that is no. In order to claim, you need to reach all of these conditions. So number one, contributing to CPF. If you are not a Singapore PR, you cannot contribute to CPF. You cannot contribute to MediSave. If you are a Singapore PR, then this is different and you need to consider this point here, point one. However, if you're not a Singapore PR, you can go straight to point two. Have you paid insurance in 2021 on your own life insurance? Yes or no? If you have, you can claim up to the $5,000. Is the insurance company that has given you the insurance, do they have an office in Singapore? Yes or no? If they do, you can claim the tax deduction. Now, this is something very interesting, and I phoned IRIS during the week when I was preparing for this to ask them this question. So if we go to point two, you paid insurance in Singapore, so you paid insurance premiums for this year. And for married men, if you have paid for your wife's life insurance policy, you may also claim the insurance premiums paid for your wife. So let's say I have an insurance policy and I pay for myself, and then my wife has an insurance policy, but I pay for that too. I can then claim both of those policies up to an amount of $5,000 in total a year for life insurance relief. But if we had to inverse that and say that a married woman has her own life insurance policy and pays for her husband's life insurance, she can only get tax relief on her policy and not on her husband's policy, which is very interesting. I had no idea. And when I saw this, I phoned IRIS to confirm whether or not that's true, because to me, that sounds a little bit weird. And it's true. So in Singapore, they actually do have some gender locked tax reliefs. So for example, women can have certain kind of tax reliefs and men can have certain kinds of tax reliefs. And this is all to encourage participation in the workforce by the different genders in a different way, which I thought was really interesting. I thought I'd share with you here today. So obviously taxes can change in the future, and it's important to consult a tax advisor, be it in Singapore or in South Africa, if you continue to have your South African insurance, and understanding kind of the tax consequences for South African insurance offshore here in Singapore if you pass away here, and Singapore insurance if you pass away in South Africa. So these are things I would always encourage clients to check up on with their tax advisors. But yeah, please do let me know in the chat what you guys think about this section here. I did find that quite interesting. Right, so moving swiftly along, we're almost towards the end of this. What are some of the things you should watch out for with insurance in Singapore? And this is very interesting because there are various different kinds of life insurance distribution companies in Singapore. So you get the big life insurers, you get the banks, you get the investment banks, and then you get offshore wealth managers or independent financial advisors as well. And each of them are selling products for different kinds of companies, and they're incentivized to sell products in different ways. So when you do come to Singapore and you're looking at taking out other kinds of insurance, take your time, read the policy documents, ask as many questions as you can. Make sure you are very clear on what you're getting yourself into and how long and how much and all the details. Something to consider is what I described earlier as a participating policy. It's called an investment-linked policy. So there are very many different kinds of this. You can have a whole of life cover, you can have a variable cover. You can also have what's called an investment bond, which is an offshore investment policy where essentially it's like a unit trust and you wrap it in 1% of life insurance. Now, the reason you would do that is for various tax benefits in different parts of the world, be it Australia or the UK. By structuring things like that, you get a lot of tax benefits and you're able to grow your money in a very tax efficient way. However, it's not always very clear as to how these products work and how exactly they're structured, where they will give you different bonuses if you hold it for this many years and it'll offset these costs. And essentially you need to be an actuary to understand how these products work. Finding someone who has a very black and white sort of product and how it works, and they can explain it to you simply, because if something sounds too good to be true, as we all know, it often is. So investment-linked policies are very useful, but you just have to find the right one and not the wrong one. And by that, I mean you get long contractual term ones that if you don't contribute your premium every month, you will lose your initial amount of money you've invested. Or you can get non-contractual ones where you just contribute on a monthly basis and you can leave it there, or you can invest a lump sum and you can leave it there or take it out when you want to. And there's just a small withdrawal charge. So just be aware of these. And if you have any questions or you've been approached by someone who has these sort of products, do let me know and I can help you understand these better. So the next one is the participating policies, which are similar to an investment-linked policy. But these ones have elements of life insurance, disability, savings, income generating in retirement. They basically tell you that it's going to give you everything you need in one policy. These are sold generally by the banks, and I've reviewed at least 6 of these in the first 4 months of this year, sold by one of the bigger banks here that most of us bank with. And essentially when doing so, I found that these were rather pricey. They don't pay out very good amounts if something happens to you. Also, the amount of income that you get is over a 30-year term, as they sell them, is at less than 2% growth a year. With inflation in Singapore being about 2%, you'd be losing money by doing this. And it's just interesting how basically the people who sell these products will explain it in such a way that you get everything you need in one policy. But when you dig into the elements, each element of the plan, you'll see that the cost is high, the coverage is not so good, and then the return on the investment element is neither here or there. So again, beware of these sorts of policies. And if you've come across any, let me know, and I'll do my best to explain it to you. Now, the last one is in Singapore. There are a lot of life insurance agencies here, be it Great Eastern or AIA or all the others. There are many of them here, and all of them are telling you that you need more and more life insurance so that the agents will get commissions on the sales. Because of this, I found a few clients who have had 3 or 4 policies in Singapore that overlap, and they were paying far too much for far too little cover, in my opinion. So do be aware of someone who will sell you a insurance plan today, and 6 months later, they'll be calling you back to sell you another one. And 6 months from then, they'll say, oh no, let's just replace both of those. Overinsurance is quite prevalent here. So please do be aware of that. And like I said, ask all the questions you want to make an informed decision, because at the end of the day, it's your money and you're going to be getting the benefit should something happen to you. So it's extremely important. Right, so now the last piece, estate planning and considerations. So estate planning considerations, what are some things you should know if you're a South African passport holder living in Singapore and you pass away? Right, the first thing is estate duty in South Africa is not like income tax, okay? Income tax, there's 2 ways to determine whether or not you are eligible to pay. You have a physical presence test and an ordinarily resident test. You can go through the process of immigrating to show that you are no longer physically present. Now, estate duty doesn't care where you are. It matters if you would be considered to be an ordinarily resident in South Africa. And the ways they define that, there are so many different ways. And I've hosted other webinars on this. So if you're interested, please do visit the SHAM YouTube channel and you'll find them. But essentially, estate duty is levied on your worldwide property. So South Africa, Singapore, let's say you have stuff in Australia, the UK, if you are found to be ordinarily resident. Now, there are various deductions under Section 4 of the Estate Duty Act that you can use to help you to lessen the burden of estate duty. But there's also an abatement. So if you pass away, the first 3.5 million rand of your estate is not taxed on estate duty. So basically you get an allowance of 3.5 million rand when you die, and anything after that is going to be taxed. Now, if you're a husband and a wife, you can pool your abatement together and have a joint estate, and your abatement then is 7 million. So anything over 7 million rand would be taxed at 20% for the first 30 million rand. Thereafter, anything over 30 million rand, which mind you is not in dollar terms, that's only $2.8 million, would be taxed at 25%, all of which would be going to South African Revenue Service. So when you take out life insurance, it's very important who you nominate as your beneficiary. Ensure that it's your spouse or your loved ones, your children, and make sure it's very clear, clean and cut who is the beneficiary and what are the consequences for that person in terms of estate duty. So if you pass away and the life insurance goes to them, is there estate duty payable? If so, how much? How do you mitigate it? These are some considerations and questions to ask. The last piece is having a will in South Africa and Singapore. If you're setting up assets in South Africa and in Singapore, it is extremely important to have a will in both jurisdictions. Why? If you do not, what will happen is your will from South Africa will go through the process of probate in South Africa, and it will get tied up in the courts there for a period of time. Once your estate is dealt with there, the will be released and it can be sent across to Singapore. The chances of getting the master in South Africa to give you an original will back are very slim. They want to keep the original and give you a copy. Then in Singapore, they want the original and not a copy. Then once your will from South Africa gets here, it has to go through the process of resealing, which is where they establish through a colonial probate act that the will in South Africa is equivalent to that of Singapore law. And then it goes through the courts in the process here in Singapore. You can imagine this is quite a timely ordeal. So to avoid it, having a will in each jurisdiction to govern the assets in that jurisdiction would enable you to bypass this. Now, something that's equally important for those of you who are parents and who have your young children with you, or any children, that in your will, you should have provision for a nominated, temporary guardian, and then a permanent guardian. So essentially, a temporary guardian is someone who will take care of your children as per your will, till such time your family from abroad can come and take care of your children and take them back to South Africa per se. Now, if you don't have this in place, you have your permanent guardians out of Singapore. Your children will be placed into government care, and that's a nice way of saying an orphanage, until such time that a permanent guardian can come and prove their ties to the children and take them out of Singapore. To avoid that, having a will in Singapore that declares who a temporary guardian is and the permanent guardians is very useful. So those are just some of the estate planning considerations that you should bear in mind. And with that, that's almost all of the information I've prepared for today. So we'll move on to questions and answers. I'm aware I gave you quite a lot of information, so please, any questions on any of this, do put them in the chat and I'll try and answer them for you now. Right, so no questions coming across just yet. So while I'm waiting, if there's anyone who's got questions, I want to now show you one of the resources that I've prepared on the South African Chamber's website for all the participants of this call today. So, okay. I'm now going to share the next screen, and hopefully you can all see this today. There we go. Okay, so this is the sham.sg. This is our homepage, and essentially here you will find a whole bunch of very interesting stuff. But the first piece that I want to bring your attention to is you come here and you go to resources. Here you will find our YouTube channel, which is filled with very useful information. The next you'll find useful documents. So you click here. And here are the first 3 how-to guides that we've done for this year. So the first one, moving money, is a flowchart. It explains how you move your money out of South Africa. The second is how do you cease your tax residency in South Africa, and kind of the ways and means you can apply a double tax agreement or a tax treaty in Singapore and South Africa. And the last piece here is where we are today, a how-to guide for life insurance for South Africans in Singapore. Now, essentially, this is just a single one-page document that I've made with the Chamber, and it compares a lot of the pieces of South Africa to Singapore. So talking about how they calculate premium, length of coverage, the escalation of premium and benefit, tax deductible, and you can click on this link and it'll take you to the Singapore Tax Authority's website to explain how it works. Global coverage. So this, again, it depends on what kind of insurance policy you have, who it's with, if it's with Discovery or Liberty, Old Mutual, ensuring that the insurance company is aware that you are abroad, ensuring that you have received notification from them that they've accepted your new address here in Singapore. All that sort of stuff is very important to understand if they will pay if something happens, and where are they going to pay? Does it go into your South African bank account Will they be able to pay you in Singapore? Will they do the multi-currency for you? These are questions that you can ask your advisor in South Africa. Now, in Singapore, generally it's international coverage, it's multinational, and it's available in up to 6 different currencies like US dollar, Aussie dollar, Singapore dollar, Hong Kong dollar, euro, and pound sterling. So yeah, this is available on the website for everyone to have a look at. And on the website, you'll also find, the other how-to guides we've done on other topics. So yeah, I hope that was useful to everyone. And as we go ahead into this long weekend, I'm sure I've given you all something to think about. I will be following up with an email after this, which would have the resource that I've just shown you, as well as the slides from today. And the recording of today will be on our YouTube channel. So you can go onto the YouTube channel and check it out. We have a whole bunch of other interesting stuff coming up on there for you to check out. And the next installment, as I said at the beginning of today, the next installment of our how-to guide is happening next week, Thursday at 5 o'clock. And so let me show you about that. Just give me a sec. Right. Okay. So here are my contact details again. Please do connect with me on LinkedIn, Michael Booth, South African flag, you'll find me. And my email is simply michael.booth@sjpp.asia, St. James's Place partner.asia. And my office is at 1 Raffles Place. If you ever just want to grab a coffee and catch up, just let me know. But in terms of next week's event, so next week I will be interviewing Dominic Folick, who is a managing partner of the world's largest immigration by investment company called Henley and Partners. And essentially, Dominic's from South Africa. He's a chartered accountant. He's been in Singapore for 5 years. He's between Singapore and Dubai at the moment, moving to Dubai last year. And what we're going to be discussing is, how do you get a new passport as a South African? What does it cost? What are your options? What are the benefits? Can you buy a passport for Europe, for the Caribbean? And what are the benefits that it will offer you? And what is, and what does it cost? So this is going to be happening next Thursday at 5 o'clock, same time, same place, but with someone else, Dominic. So we'll be interviewing him, and he'll be sharing his insights on this, and providing a lot more information about the green mamba, as we call it, and its use as we now no longer live in SA. So everyone, I haven't received any questions. Please pop them in here. Let me know if you have any questions from today. I got 1 thumbs up. Thank you, Craig. Appreciate that. And thanks, Masizwe. Appreciate your time. Thank you for joining us. And Kerry, thanks for joining us. Polka and the High Commission, thank you very much for joining us this afternoon. We appreciate it. We wish you a great, Freedom Day, and I hope that you guys have a National Bra Day and get to relax over the weekend. And hope to see you all soon. Please do participate in further South African Chamber events as they come up, and get in touch with me. I'd love to meet more people in the community. With that, we can call it a night. Thanks everyone for coming.